Good afternoon, everyone, and welcome to the RealNext webinar series, our CRE Market Outlook 2023, our mid-year outlook with Dr. Jeffrey Fisher. Once again, joining us, Dr. Fisher is Professor Emeritus from Indiana University, President of the Homer Hoyt Institute, board member of NCREIF and RealNext, and co-author of Real Estate, Finance and Investment, as well as Income Property Valuations. Well positioned to advise us on where the real estate market is today and where it might be headed based on the research and work he's done with NCREIF and that group in particular, the institutional real estate investors. And Dr. Fisher's been with us many years now, presenting his findings, and what a stark difference it is year over year. Last year, the mid-year session that he provided was entitled Back to Normals, after 12 months of returns exceeding 20%, cap rates pushing lower and lower, even in the face of rising interest rates. It seemed like we were just about to reach the peak of the market. And now 12 months later, prices have dropped for the past 3 quarters. We have negative returns, rising cap rates finally impacted by the rising interest rates, and particular challenges in the office market, not just in vacancy rate, but in occupancy rate in particular. And capital has become increasingly difficult to find. So it's a different market today, Jeff, and look forward to hearing what you have to say and hearing what the audience has to say. I know there'll be some polls along the way to get their perspective of where things are and where they're headed as well. And for everyone, the question box is open to pose your questions along the way. We'll do our best to address them all and get you a recording and the deck after the session. So Jeff, take it away.
Thank you, Jeff. Good introduction and overview. I just noticed my, this is my fault, my first name is actually spelled, pardon?
You're missing enough there.
Yeah.
Maybe that's a sign of the times, we just.
Yeah, so as Jeff kind of indicated, things are quite different than they were a year ago. Certainly the institutional investors that I work with are kind of pessimistic, and we'll talk a lot about cap rates, but if anything, they're saying, gee, we haven't seen cap rates rise as much in a lot of the appraisals that are being done as, we think, they really have in the market based on the cap rate that we have to do transactions at. So a lot of them are still kind of pessimistic that the Fed is not done yet. As the title of this slide says, actually, this slide came along with several of the other intro slides that I have from the person that I presented a similar webinar with, similar slides to the institutional investor organization. And he certainly doesn't feel that the Fed is done yet. And he added this quote on the right here from Bill Dudley, who's a former president of the Federal Reserve Bank of New York and was vice chair of the Federal Open Market Committee. And he points out that if the Fed is looking for kind of a real rate of return of 1% over the next 10 years, and inflation averages 2.5%. I know they talk about getting it down to 2, but a lot of people think if they get it down to 2.5, they'll be happy. And then you add a risk premium onto that, you've got a 10-year Treasury rate about 4.5%. So we may have already seen the low interest rate environment that we've had the last 10 or so years. More than that may be a thing of the past. Although I remember when I had a mortgage of 18%, so it's all relative. But you can see the impact of increases in rates because of what the Fed's been doing, and the increases they had in September and on through current year. So, and a lot of talk of economists is about how the inverted yield curve, when the long-term rate becomes lower than the short-term rate, tends to predict recessions. It's not always perfect, but you see here going back to 1967, the gray areas are recessions that we had, and the red line is that difference between the 10-year and 3-month Treasury. And you can see when it goes negative, goes below the line there in the middle, that's usually followed by a recession. More recently, we saw that with the financial crisis in around 2008, and we saw that to some extent with COVID, just a minor, if you want to call it, recession, and the curve became inverted there for a short time. But you can see it's really quite inverted right now, although it did seem to improve just a little bit the last months. But that's the concern that a lot of economists have, that we are going to have at least a soft landing, as they keep talking about, some sort of recession. I think there's still a lot of hope that it's going to be more of a soft landing than it's going to be anything more severe than that. But as I'm sure that most people on the call know, the commercial real estate credit conditions, continue to tighten. What's shown here is the blue line is sort of an indication of how tight credit conditions are. So when it's dropping, those are tighter credit conditions. Going up, it's less tightening. And so you can see we're again in the lower end, as low as it was, or maybe even slightly lower than it was during COVID, and almost as low as it was during the financial crisis of the 2008 time period. The green line is the change in value of the index that I'll be talking more about. It's the index of the performance of funds held by the properties in the funds held by different institutional investors around the country, the Morgan Stanleys and JP Morgans and Prudential Real Estate, Invesco's, and so forth and so on, that manage money on behalf of high net worth investors and pension plans around the country, like CalPERS and CalSTRS. There's about $1 trillion of properties in the index, over 1,000 properties, and pretty good gauge of what's happening in the market. Although it's a measure for institutional real estate, it's highly correlated with what's happening in the overall market. So back to the green line, so that's the year-over-year change in prices, and you can see that tends to be highly correlated, maybe a little bit of a lag with when the credit gets tighter. So you can see the credit got tighter, and as you'd expect, that green line is coming down. Whether it's going to keep coming down, we'll see what you all think when we get to some of the polling questions. But certainly there's some evidence that it may see some further declines. We certainly have the lowest commercial real estate transaction volume that we've had in years. You can see here each year here that's shown: 2019, 20, 21, 22, and so far in 23 up through July, starting at January, where each of them are starting at pretty much the same point in January, and you can see what's happening over time, and almost each year it's lower. Well, I take that back. In 2021, it kind of jumped up near the end there. 2022 looks pretty good, but then you come down to where we are today with the red line at the bottom, and it's lower than the line that started in 2020. So it's the lowest of any of those years that are shown there. So certainly not off to a good start for the first 6 or 7 months of the year in terms of transaction volume. And you can see how that's also related to what's happening with the cap rates. The cap rates here are for the average of all the property shown in that orange line. So it says the NPI, which is the NCREIF Property Index. That's the organization I mentioned. NCREIF is National Council of Real Estate Investment Fiduciaries. That's a mouthful. So if I say NCREIF, just kind of think of that as the Organization of Institutional Investors. So their property index, NPI, is shown there. So that what you're seeing is the cap rate on the NPI. Okay, so the cap rate on those properties, which, no surprise, it's going up over the last 3-4 quarters, and you can see how that's related to the transaction volume, which is way off, which is also broken down by the different sectors. So transaction volume down as cap rates are up, kind of makes sense from an economic point of view. And it's most acute in apartments and industrial space, which you can see here. You see the cap rate on the left for apartments, and then you see the cap rate on the right for industrial, which is mainly warehouse properties. And again, what's happening with the transaction volume. But certainly, as cap rates have been pushed up, and so far, I'll get into this more in the later slides, but I think most of the impact on transaction volume and pricing and everything has been more, just due to the rise in interest rates and what that's done to cap rates. It's starting to impact net operating income, but the NOI growth is actually still positive, as we'll see on a later slide. Sometimes we talk about that real estate can be impacted by both what we call the space market, the market for the space in the buildings, the leasing of the buildings, and then the capital market, which is your cap rates, interest rates, et cetera. And so far, it's been mainly the capital market that's been impacting values, but it looks like there's been some deterioration taking place recently in that space market as well, as we'll see on a later slide. So office property loan problems increasing. No, we all know about the problems going on in the office market, at least in a lot of the metropolitan areas. And so you see loan problems are starting to go up. Delinquency rates are going up on commercial mortgage-backed securities. And we'll see some additional indications of what's happening. Specifically in the NCREIF database, we'll see where some of the properties are underwater, even though they maybe haven't given them back to the lender yet. They could with the non-recourse financing, and we'll see that certainly the leverage has turned negative in recent quarters. So actually, my guest from that last webinar that I referred to added this slide where he did some research. So this is maybe taking a more optimistic perspective than I've maybe sounded like I've had so far, titled "Long-Term Investors Don't Need to Call the Bottom." And what he did is he went back to previous recessions. So we had a recession in the early 90s. We had the tech bust, same time as we had 9/11 in the 2000s. And then we had, of course, the more recent financial crisis in 2008. That's not so recent anymore, but the most recent major recession that we've had. And you see, if you bought at the bottom, although it's hard to predict when the bottom is going to be, but if you did, you can see you get really nice returns thereafter, certainly in the double-digit range. And this is institutional real estate without any leverage on it, so you would do even better if you had leverage properties and in the sectors where you're taking on some additional risk. So he's actually seeing clients coming to him and saying, I know if I wait till we know that there's a bottom where the indexes have started to turn around and everybody's saying the market has recovered, then it's too late because there's queues to get into the funds that they want to invest in. And so it could take 6 months to get into a fund, and then it's too late. So he's seeing investors starting to jump in now, which maybe is a sign that we're going to start to see things turning around, because investors don't want to wait until they actually know there's a bottom, because then it's too late to really take advantage of the higher returns you can get because of what we call the queue to get into those funds. So looking more specifically at the NCREIF data, and I know a lot of the indices here, unless you've maybe been on some of the previous calls, I don't always show this graph, but you may not be familiar with what all these things are. But starting at the left there, NPI, and I put at the top, NPI stands for the NCREIF Property Index, as I mentioned before. So the one that says NPI Research, you can just think of that as really the main database that has all the 1,000 properties in it. over $1 trillion of market value. And you can see what the performance was of all those properties based on the last quarter, which is the gray line, which was the -2% rounded, so about a -2% quarterly return. For the last year up through the second quarter, it was a -6.6% return. And then you can see what it was on a 10-year and a 20-year basis. So we don't need to get into the subtleties of all the differences here, but if you lever those properties, that, no surprise, takes you to a -3.1 instead of a -2, or on a 1-year basis, a -10 instead of a -6.6. We all know leverage can be negative when you're in a situation like you're in today, where you're earning less than you're paying on the debt. And then the one that says Odyssey is just a subset of those properties that are the most core, the lowest risk of the funds, which again can be looked at on a leverage basis. And then the next one, NFI Odyssey, is a fund index, which is the performance of the fund itself as opposed to the properties in the fund. So again, probably the details aren't that important for this call. The main difference is funds also have cash balances, and the manager gets a fee to operate the fund, and they may have some other investments and so forth. Also, it might be interesting to look at farmland and timberland. Those were both positive, down, of course, from the year and the 10 or 20-year average, but both farmland and timberland eked out a positive rate of return. The S&P 500, we know that's come back quite a bit, so it's showing all positives. And what's interesting is the REITs were up this quarter, the 1.2%. And the reason I point that out is REITs are all often pointed at and it's considered a leading indicator of what's going to happen in the private market. I don't know that that's always true, but a lot of people believe that REITs are a leading indicator of the private market. And up until this quarter, REITs were down quite a bit, and everybody was saying, well, the private market is not kept up with what's happening in the public market. Well, now REITs have turned around and become positive. So does that mean things are going to turn around in the private market? We'll see if it stays positive next quarter. I think there's just a lot of noise in what's happening in the public market. And I'm actually going to in some later slides show some cap rates that are implied by REIT prices that Green Street puts out, and a lot of people like to point to, and sort of show how that differs from your private market cap rates. All right, so looking at the returns over the history of this NCREIF property index, this is on a rolling 4-quarter basis. So you can see we've only had 3 times when it went negative in this entire time period from 78 through 2023. So only 3 times that it actually turned negative. Didn't turn negative during the tech bust. And as Jeff pointed out, it's also the 3rd quarter in a row that we've had negative returns. So we certainly are in negative territory at this point. I guess I should also point out, and this is a rolling 4-quarter, so it's not even as obvious as it would be if we looked at quarter by quarter, that we did have, especially during the 2008-2009 period, we had a real V-shaped recovery. So things went down pretty quickly, but then came back pretty quickly. I guess that relates to the earlier chart we looked at that talked about how, if you can catch the bottom or maybe jump in a little bit before the bottom, you can get some nice returns going forward. So if we have another V-shaped recovery, things could turn around pretty quickly. Maybe not before the end of this year, but could be pretty strong next year. I also looked at just the change in values of properties in the index, and index that going back to the beginning of the index, which is in 1978, and I added the index of the consumer price index over the same time period. And I thought it was interesting that although there were periods of time when the blue line, the market value index, dropped below where inflation would have taken us. Right now, they're pretty much at the same point. So from 1978 through 2021, property values kept up with inflation. Um, but on top of that, you've got your cash flow return, right? Because you got net operating income on the properties minus, of course, any capex that goes into the properties. And that cash flow return over this entire time period was 4.6%. So basically what you did is you kept up with inflation each year. And again, this is on an unlevered basis. You kept up with inflation in terms of your property values. And on top of that, you earned a 4.6 cash flow return, which of course you could lever up. And again, this is institutional real estate, which would be the lower end of the return spectrum. So I think it's kind of encouraging that real estate, you could pretty much say, has been an inflation hedge. It's kept up with inflation. Not everything has time periods when it didn't exactly, but overall, it's pretty much kept up with inflation, which I always tell my students there's reasons for that because of the way the leases are structured and because it's a real asset and construction costs go up and replacement costs go up with inflation. And usually it does much better than a lot of other asset classes when you have unexpected inflation. This is how the property were allocated across different property sectors in the index over time, which I think is kind of interesting. It sort of tells you the appetite that institutional investors have had for different property sectors. Of course, some of these changes would be also due to price changes, relative price changes, we should say. So maybe no surprise that retail at the top really has lost a lot of share of the allocations in institutional investment portfolios. We know certainly what's been going on with retail, and we also know what's been going on with office, which we'll say more on some later slides. But office used to be 40% of institutional investor portfolios, which I never quite understood that it was that high a percent, but that's certainly come down. And no surprise, what's going up, labeled here industrial, but that's again warehouse for the most part. It's almost virtually all warehouse space, and we know the story on warehouse space since COVID, and how those values have gone up and the demand for warehouse space has gone up. Supply is starting to catch up, but certainly in industrial properties, although they've also suffered with everything else in the last quarter, they've really been the best sector for many years actually. And in hotel, there's just a small amount of at least in these funds in hotel properties, since they're more of a business. So you just see a small slice there, but they actually have performed the best in the last couple of quarters. And then you see apartments have also gained in terms of allocation. So apartments, industrial have gained in terms of allocations from institutional investors, retail and office have lost ground. No surprise, there's been a lot of write-downs of properties. If anything, I keep hearing that maybe there should have been more write-downs. Some of the appraisers seems to be a lot of disagreement, and this happens whenever there's a big drop in the market. There's disagreement among appraisers because you don't have the transactions that necessarily back it up. So some appraisers are saying, well, you should have written down properties more. Others appraisers are saying, well, I don't have the evidence of that yet. But you still see the number of write-downs here, the red line, compared to the green line, which is your write-ups, certainly has gone up a lot, down slightly this last quarter, but certainly quite higher than it's been since really going back to the financial crisis. It's higher than the number of write-downs that we saw during the COVID time period. And if we look at office space, I drilled in on that one since we know that's the most troubled sector. You can see the number of write-downs for office space is all the way up to 70%. It looks like that last quarter actually hit exactly where it was during the financial crisis in terms of write-downs for office properties. So that sector certainly is having some problems right now. Although it really depends on on the particular property and the market that it's in. There's certainly some office properties that are performing quite well right now. Others being converted into apartments. We read a lot about that. A lot of conferences. There's people talking about the benefits and the challenges of converting office properties to apartments. What I did here is look more at leverage. So in the top left, the percent of properties in that index that have negative equity. This kind of surprised me. First, it surprised me that there's always some properties that have negative equity. And it's like, well, if they have negative equity, why aren't you sending it back to the bank? Because they're usually non-recourse financing. But I think it's because these properties are in funds where not every property in the fund has leverage on it. And so when you look at the leverage for the overall fund, it's still very conservative, maybe 30%, even less than that on a lot of the fund's leverage. And so they really don't mind if some of the properties end up having negative leverage. And in fact, I think what they're trying to do is say, I don't want to put leverage on every property. That's too costly. I'll put leverage on, maybe 20, 30% of the properties, but on those properties that I'm going to borrow money on, let me borrow as much as I can. So when I look at some of these, I see, where they just borrowed up to 90% if they could. And sometimes that didn't work because values dropped over the next couple of quarters, but they just held on to them. But anyway, aside from that, you can see it really only peaked way up during the financial crisis. So this is sort of contradictory, it seems to me, to some of the other stuff that I looked at, where the percent of properties with negative equity, at least among these institutional properties, really hasn't gone up over the last year, as opposed to some of those other things we looked at earlier, like the delinquency rates on the CMBS and some other things that kind of showed, quite a bit of an increase the last couple quarters. And also, when I look at the bottom left, these are the percent of retail properties that have negative equity. Same story. So even with retail, and then to the right with office, although you see a little bit of a blip up there for office, but nothing like we had during the financial crisis. So thought it was kind of interesting that we're just not seeing that degree of negative equity in properties right now that we saw back during the financial crisis. And maybe that's because since the financial crisis, lenders have been stricter on loan terms, and maybe that's a good sign that we won't see as much trouble in terms of mortgage defaults as we had after the financial crisis. I know that you hear a lot of concern about that and loans becoming due over the next couple of years, but certainly in the properties that I'm looking at, you don't see a major problem so far. Then I also looked at whether the leverage itself was positive or negative. So on the top left, I'm looking at it based on sort of the current yield, like are you getting enough income to cover your debt service? Okay, and you can see that's become slightly negative, kind of like saying cap rates are below your mortgage constant right now. You can see the last time it dipped negative was during the financial crisis, and before that, the 2000 time period, the tech bust. It's negative for a lot of the time during the 1980s, but that was just a different tax law environment that sort of encouraged you to borrow a lot of money, and you could have negative leverage on a current yield basis, but still on an IRR basis, it was positive leverage because of the tax benefits and the price increases. And looking at it on an after-tax basis, it looked positive. So you see that on the chart at the bottom, where even during that time period, the leverage was positive until we got to the late 80s recession. Then again, negative on an IRR basis when we get into the 2001, 2002 time period. Really negative during the financial crisis, turned negative a little bit during COVID, and then negative again the last couple quarters. Although again, signs of improvement. And then on the right-hand side, I'm looking at whether the NOI is covering your interest rate, kind of looking at a debt coverage ratio. I use just the interest rather than the principal payment. A lot of these loans are interest only. But you can see that certainly the the number of properties that, and this is the number of properties in this case that have NOI less than the interest. Okay, just to be clear, this is showing where the NOI is less than the interest. You can see that has been going up. So you do have properties where the NOI is not covering your interest, and that, again, would be part of the story, and why on the left-hand side we see the negative leverage in terms of the return. But again, as we saw, that doesn't mean that these properties are going back to the lender. Out of those 1,000 properties that are in this index, we only saw 5 that were returned to the lender this last quarter. So only a handful of properties where they said, well, we're going to give that one back to the lender. So with what we've talked about so far in mind, and what you all are seeing in the market, where do you think real estate, doesn't have to be institutional real estate values will be at the end of 2023 compared to now? I think if we try to look at it for the whole year, we kind of know that they're probably going to be down. But compared to now, are they going to be somewhat lower by the end of the year? Are they going to stabilize at the current level? Will they be somewhat higher by the end of 2023? Or even some of the people on with the institutional investors said, I have no idea. And Jeff, you can report on the polling results. A little easier for you to pull it up than.
Yep, we'll just give everyone a few seconds. It looks like they're coming in pretty consistently.
I think we all want to see what everybody else is thinking about this.
Yeah, I think we're solid here. Close it. Share the results. So it's 52% felt values would be somewhat lower by the end of the year, but strong feeling that the 38% stabilization, and 10% not quite clear, and 0 thought they'd be higher. So pretty biased to the negative, but not severely negative.
Yeah, that's very consistent with what we got from the institutional investors as well. So probably going to be somewhat lower by the end of 2023, but hopefully that'll be the end of it, and things will turn around, and the Fed will start lowering interest rates, and we'll be happy again. Although, of course, you can make money in all markets if you buy and sell at the right time, right? Hotels are the only
ones you really make money is where you buy. So as you said, you don't have to catch the absolute bottom, but if you catch, you're there a little bit before or just at, and even after, you're still in good shape. So buying right is the key, and just a matter of having the capital to put the transaction together to take advantage of the opportunities that exist today.
So as I mentioned before, hotel, the only positive return sector this quarter. Otherwise, they're all negative. I think no surprise. Office is the most negative return. Apartments negative, retail just slightly negative, and then industrial turned negative last quarter for the first time after we had obscene returns for warehouse space for many years. Even on an unlevered basis, there were like 20-25% returns. Rent and NOI, I alluded to this earlier. Up until this quarter, I was saying, well, there's no problem in terms of the fundamentals. But you see rent growth has dropped off, but it's still positive. We still have rent growth. I know somebody asked during the last webinar why, and maybe this is more on a later slide when we get to the different property sectors, but why we're still seeing positive on office, and we kind of concluded that it's those existing leases that are still rolling over. When we start to see new leases being renegotiated, we may see more of a decline in rent growth. But up to this point, we've got positive rent growth and positive NOI growth. It is dropping off, which is kind of a concern, because if it does go negative, I think coupled with cap rates rising, if they continue to rise, you get kind of a double whammy there. I mean, up to this point, I've argued that the positive NOI growth has helped offset the effects of the rise in cap rates, because they pulling in opposite directions, right? The rent growth being positive would tend to pull cap rates down. But then the interest rates going up would tend to pull the cap rates up. So if rents continue to deteriorate, we've got a bit of a problem. And they were negative for retail, no surprise there. But office again was positive, which surprised some of the people on the last webinar. And industrial was still pretty strong, around 2% for rent growth and 2.5% for NOI growth, and uh, apartments 1%, still around 1%. The scale is a little bit different on the bottom right for the NOI growth. So have to keep our eye on both the rent growth and the NOI growth. I like to break down the return into the components of the return. There's been a lot of interest in this, as uh, I've shown it in recent webinars, and because it kind of tells you, okay, what is it that's really driving the returns for each of these sectors. And you can see that the NOI yield being positive helps, and the NOI growth being positive helps. Um, that's pulling the returns up, but it's the cap rate change, the yellow, okay, the yellow that's really pulling the returns down. And so it's a tug of war between the yellow going down because of the cap rate change and the NOI growth. As I said before, they tend to pull things in opposite directions. So you can see the scale is a little bit different on each of these, but you can see, for example, when you look at office on the top right, the cap rate changes are really hurting office properties. Not so much on retail anymore. In fact, it's actually been less of an impact in the current quarter than it was a couple quarters ago. Same for industrial, where the cap rate changes really hit us 2 quarters ago, and even apartment. So really everything but office. Um, Although the cap rate changes are still hurting us, um, they're not hurting us as much as they were several quarters ago. So, and if the Fed starts lowering interest rates, that could turn positive again, as it was back. If we go back to 2022 second, well, it depends on the property type, but if we go back enough quarters, we see where cap rates were helping us. Cap rate changes, I should say, were helping us. So this shows the I used to say occupancy over time, but I realize in the current market I need to be more precise on this. What's actually collected for this database is the percent leased on the properties. It comes from accountants, and they pull the percent leased out of their database, and I think you all know more than me that you can have somebody paying their rent, but that space is not occupied, and so that's why I purposely crossed off the occupancy and said it's percent leased. I hear the term phantom space, which I think means the same thing, Jeff, as shadow space. Um, the idea that there's space that's lease payments are being made on it, but it's not being occupied, may be available for sublet, may not. And we can look at that also by the different sectors. So occupancy is still pretty high on apartments, and everything I'm hearing, the long-term trends are still very positive for apartments. We need more apartments and more housing in general in this country. Industrial is still near 100%. So unless a lot of supply starts coming online, we're still pretty tight on industrial space. So even though returns have dropped off, we still have very high occupancy. Um, Office a little bit lower, of course. Around 80, 84, 85% maybe right now. Retail has improved a lot in recent quarters. So what property sector do you think will perform best for all of 2023? Another polling question here. Do you think it's going to be apartment, hotel, industrial, office, or retail? That may be a little tougher to answer than it's been in the past. For a while there, everybody picked industrial as what was going to do best. But retail has been recovering. Hotel was the best performing sector this last quarter.
All right, wrap it up.
Let's see what we got.
And not too surprising, industrial still leading the pack with 54%, followed by
Okay, it was for
food.
the institutional investors as well.
I'm surprised at hotels, just 6%. It seems like that is faring quite well in the market,
Yeah.
um, and retail on the books here with 6%.
Okay. What was office? Anything?
It's zero, yeah, zero for office.
Okay. And apartment?
34%.
34% for apartment. Okay. 34% for apartment. Right. Aside from the low for hotel, apartments don't surprise me, and industrial doesn't surprise me. Although I've sort of learned that these things don't last forever, right? So at some point, industrial is not going to be the best. But so cap rates. This is maybe more detail than we need to go into on this call, but just some high level things here. Um, and maybe the main point that I want to make is be careful when somebody quotes you a cap rate, because there's just a ton of different ways that cap rates can be calculated, whether they're based on last year's net operating income or next year's net operating income or stabilized net operating income, especially if it's a development project, and it's what it's going to be once it get leased up to a normal occupancy level. And you got cap rates that are being used to appraise the properties in the index that I keep talking about. That's what's the basis for reporting to investors, but also on the open end funds, it's what people are paying to come in and out of the fund. It's determined by those appraisals. Um, and then there's cap rates based on transactions, which we don't have a lot of in this database because the institutional investors tend to be long-term hold. But we do have transactions every quarter, and so we can calculate the cap rates based on transactions. And then I took a close look this time uh, for the first time in what Green Street produces, because a lot of people uh, like to show charts that show that the cap rates that come out of Green Street are a lot higher than the cap rates that we have at NCREIF. And usually what they show us is that bottom one that says Green Street implied, which is a cap rate that basically says, what would the cap rate be if I use the net operating income to get the value of the REIT as a stock, plus of course the value of the debt. So it's a cap rate that's implied by what investors are willing to pay for the REIT as an operating company. Um, and actually, these bullets that I have under it came from the director of research at Green Street. That I said, well, explain to me, what influences these cap rates, because it seems to me that they're impacted by a lot more things than just the value of the real estate, and why they more volatile, which he said they are, and said it reflects more than just the value of the underlying real estate. It can be influenced by the growth and um, merger and acquisition activity and the development pipeline, and even how investors perceive the strength of the balance sheet of the REIT. And so um, there's a lot of reasons why the REIT cap rates could be quite different than a cap rate that you use to value the underlying real estate. And in fact, they have what they call a nominal cap rate, which they use to estimate the private market value of those properties held by the REIT, which should be more similar to the appraisal cap rates that we have at NCREIF, although REITs do have a different uh, composition of properties in them. So I just did a comparison for apartments based on the cap rates I got from Green Street, then comparing with NCREIF, and you can see that implied cap rate for apartments is the highest. But again, that's based on what investors are paying for apartment REITs that are publicly traded, which I think tends to sometimes overreact. Sometimes, uh, sometimes they may lead the market, but other times they may be quite noisy, and investors tend to overreact in public markets. And so, even though those are the highest, I don't know that that's necessarily the truth. The NCREIF appraisal cap rates are at the bottom, and maybe they haven't risen as much as they should. Hard to say. And in fact, based on those properties that did sell from the NCRE property index, you can see the yellow line there is higher, and in fact lines up right now almost perfectly with that Green Street nominal cap rate, which, as I mentioned, is what they use to value the private real estate. So again, that may be a bit more than you need to know about cap rates, but uh, I want everybody to realize that when you hear a cap rate, be careful, because there's a lot of different ways that people come up with cap rates, a lot more than I'm even showing certainly here, um, and just got to be really careful how you interpret it and make sure you're comparing things on an apples to apples basis. But using that REIT implied cap rate along with the NCREIF appraisal cap rate and transaction cap rate, here's another chart that looks at it across all the different sectors, kind of averages things across apartment, industrial, office, retail. And so you can see there is a difference. That REIT implied cap rate, like we saw in the last chart for apartments, is a lot higher um, than the appraisal cap rates. Whether where the truth is, maybe it's somewhere in the middle of all three of these, or maybe where the transaction cap rates are, which is in the middle, right? The NCREIF property index transaction cap rates based on the properties that sold. And then here's a comparison of the cap rates for each sector from NCREIF with the BAA, which what's interesting here is that over time, the BAA is a pretty good indication of where cap rate should be on average. So there is a bit of a concern here that the BAAs have jumped up above all those cap rates. So that may be an indication that the cap rates are going to keep rising a little bit. Although we could see the BAA start to come back down again if the Fed, maybe they only have one more increase this year and they signal that that's it. We could see those BAAs come down and line up again with the cap rates. So wish I knew exactly where they were going to be headed, but easy to look at where they've been. Not so easy to figure out where they're headed. But here's a breakdown of the same type of information across the different sectors. So you've got an industrial. I think it's interesting here that the NCREIF transaction cap rate is actually higher than the REIT implied cap rate on the industrial. So maybe industrial cap rates are going to start to come back down again as they had been. Office cap rates, big difference here, right? The public market is really concerned about office space, probably more so than the private market. Even the transaction cap rate here dropped back down quite a bit this quarter, and not too different from the appraisal cap rate used to appraise all the properties. So I don't know, maybe the public markets, because they're reading all the stuff coming out in the media about office space in certain cities, are a lot more concerned about the office space than maybe the private investors that hold a lot of these properties and maybe know a little bit more about them than the media. And this is also office cap rates, but broken out by suburban and CBD. So you can see where suburban cap rates have been higher. Gee, was there ever a time they were lower? I guess not. So suburban cap rates are higher than the CBD cap rates. Although the gap there is kind of narrowed. Uh, not quite as much of a distinction between the two as we had several years ago. And then for retail, so again we have the REIT implied, and then the NCREIF, and also the REIT implied for malls, which is your highest. Of course, that's where we've probably seen the most problems is with the malls that are losing the anchors. And then getting near the end here, we've got a breakdown of some of the what we call alternative sectors that are not in the main index, but NCREIF collects the data on these, and there's just been increasing interest in these. And in fact, the funds that have done the best seem to have more of an allocation to some of these other property sectors. So you can see student housing is still in positive territory. So even though it's come off its highs, student housing is a positive return. Um, Senior housing is a positive return. Looks like self-storage dipped into negative, but it's back to break even. And medical office is close to being a positive return. So these alternative sectors have held up quite well over the last couple of quarters. And then I've never shown this before, but we now have enough data to look at data centers, break that out. And we all know, there's just been increasing demand for data centers, and all the talk about artificial intelligence and being able to support, you know, all that is creating a need for data centers. So a lot of people are pretty bullish on data centers, and those are in the dip down in the negative, but then back into the even. In fact, the last 2 quarters they were at least 1% on a quarterly return basis. Parking, so that's kind of the opposite, right? If you people aren't driving to the office, then they're not parking. And then the peak to trial decline in capital values here, it's broken out by all the different ways we can break out subtypes. So you can see um, central business district uh, hurt the most. So the top had the most decline over the last couple quarters from what it was at the peak, and then followed by urban office, what we call secondary business districts, suburban office. Um, don't need to read them all off, but you get to the very bottom there. So the least impacted has been hotel, full service, student housing, which we saw has recovered nicely. Um, what data we have on manufacturing has held up, and then strip retail has not been hurt as much as some of the other retail property sectors. Warehouse kind of in the middle there, life science, um, data centers kind of in the middle. But again, those have recovered nicely the last couple quarters. So what do you think the return will be for institutional real estate for the calendar year 2023? So for the whole year, I put at the bottom where we currently are for institutional real estate at minus 3.8%. But I think to answer these questions, you don't even have to think about it as institutional. I added here before you pull up the polling itself, Jeff, just think of A as getting a lot worse, B as slightly worse, um, C as prices are going to stabilize or slight recovery during the rest of the year, and D, significant improvement for the rest of the year. Maybe from the earlier question, we can kind of guess at the answer, but I suspect we'll have a lot of A's and B's here.
Oh, you might be surprised, Jeff. Let's see. Here we go. The You're right with B. 55% thought negative to 5 to 10%, but a little bit more optimistic, more of a C category. 31% thinking 0 to negative 5, and 7% positive, and 7% severely negative. So closer to the middle than the extremes.
Good, good, good. Right. So kind of a summary for second quarter 2023. Returns were negative for the third straight quarter. As I also showed that, only 3 times in this whole history that we have negative returns. Where, and when I say that, I mean periods of time where they were negative for several quarters or even got into negative territory. Market values fell for the fourth straight quarter. So returns down for 3 quarters, but market values fell for 4 straight quarters. The difference being income kept the return positive, at least 3 quarters ago. Only hotels had positive returns. Office, no surprise, was the biggest drag. Rent and NOI growth starting to deteriorate, although it was still positive. So it's not a negative territory. There's still growth in net operating income and rent. percent leased was down just a little. Cap rates continue to rise, so we saw that's really hurting us. As I mentioned before, only 5 properties out of those 1,000 or more properties were returned to the lender. So we're not seeing any thing there that seems to be a red flag. 47 properties this quarter have a value less than or equal to the loan balance, but again, that's a pretty small percent. And we're not seeing those properties being returned to lenders because again, they're in a fund where there's other properties that maybe don't have any loans on them, and so they want to keep the property. So I guess we have some mixed signals here, and maybe next quarter we'll have a little bit more clarity on where things are headed. So we'll do an update either next quarter or certainly the end of the year to see what's happened.
Well, if we found the turning point last year with the session, perhaps this will be a turning point as well. Let's hope so. Let's hope that we start to see some tighter lowering of interest rates and improvements in the capital markets and continued strengthening of the fundamentals to drive values. Jeff, thank you as always. We're right on time here, and it seemed like the audience didn't have a lot of questions, or you addressed them before they got to ask. So we will wrap up, take it from here. Hope you all have a great rest of the summer, and we'll see you next quarter, and look forward to future sessions with you, Dr. Fisher. Appreciate your time.
Thank you. Bye-bye.